It's time for ETF Friday, and today we're looking at junk bond ETFs in particular. They saw some big swings in flows this week. With us is James Seyffart of Bloomberg Intelligence. Talk to us about the flows, the swings, where they went and where they came from, the funds.
Yeah, so if you're looking at fixed income ETFs, which are big in the market right now with everything that's going on with rates, we've seen wild swings in junk bond ETF flows. The past two weeks have seen near record flows in and then out. So there's a lot of things going on here. And in October, we saw $4.1 billion leave high yield ETFs. And we're basically neutral in November. But right now, overall, we've seen a ton of money, like I said, leaving fixed income, but there's one bright spot. Ultra short and short-term duration have seen almost $8 billion of inflows since October. And all this volatility and what's going on with flows is likely due to a few different things. One, obviously, Fed raising rates, but also we've seen the 10-year yield go from 3.23 to under 3.10 in the last week. So there's a lot of confusion going on in the markets, I guess. And the other thing to note here is that HYG, which is the biggest, most liquid high-yield ETF, is at its highest short interest ratio. So there's a lot of shares short. So there's a lot of people on both sides of this trade, and there's a lot of volume going on.
James, let's talk about the energy trade. One of the factors that has driven that 10-year lower has been the fact that we have seen energy coming under a little bit of pressure. As it's come down, that's obviously implicated other assets. But when you take a look at junk bond ETFs, what does the exposure within those ETF structures look like to the energy space? And if it's substantial, is that something we need to worry about? Yeah,
so if you look at, like you talked about, HYG, most liquid, most traded high-yield ETF, most assets, it's seen its energy exposure go from 10% to 15% in the last 3 years, which investors should be aware of. One of the things going on in high-yield debt right now is that a lot of energy high-yield debt is sitting at that crossover between high yield and investment grade, so triple B and double B. So as oil rates are falling, there's a lot more likely to be downgraded, depending on how those companies are hedged. But the thing is, it might not be a bad thing, right? We have a bunch of ETFs here that have really high exposure to oil. And the last time we saw a huge fall in oil was in late 2015. And in 2016, a lot of these ETFs have severely outperformed in 2016 versus overall the broader based HYG. So if you think that oil is going to flat here or going to stop falling or even rise, some of these other ETFs might be a better choice.
Well, exactly. If you do want exposure to junk ETFs, but you would rather not have the exposure to the energy complex, what is on offer?
Yeah, so there's HYXE, which is a ticker offered by iShares. It's the high yield sector X energy. So what you get here is iShares launched this in late 2016 after the downfall of oil in 2015 through early 2016. And ironically enough, it basically launched right at the bottom of oil. So it launched at a time where no one was going to use it, but now might be a time for it to shine. And it's just indicative of what happens in the ETF world. There's a lot of things that happen are big movements and trades, and people are worried about their exposure to energy all of a sudden, and then some ETF issuer launches an ETF. And by the time it launches, it's often past the time for that trade to even work.